Let me once again thank Secretary Paulson and Chairman Cox for agreeing to come before the committee in such an expeditious manner and way. As you know, for the last hour and a half or so, we've had a good hearing with the Secretary, the Chairman of the Federal Reserve. We thank Chairman Bernanke for his involvement, and I'm deeply grateful to Senator Shelby and others for allowing us to have this hearing on an expedited fashion, waiving some of the rules that would otherwise be necessary. Let me just suggest a couple of things. One is, obviously, as we look at these proposals, Mr. Secretary, that have been raised over the weekend, I want to thank you. I want to commend you for putting forth some ideas here on how we can deal with this present situation. And so I begin by suggesting we're all trying to find some common ground and some common answers here that make sense, both in the near term and the longer term, for economic stability, for restoring confidence and optimism in our country. Chairman Cox and I had a good chance to talk over the weekend as well on some of the ideas that have become the subject of public debate and discussion over the last 24 hours or so. It's also important, and I think all of you understand this, that as members of this committee, we've been charged with the responsibility of oversight and jurisdiction on these policy matters. And so it's important that we be probative as well of these issues as to how they would work, what the impact could be, what are the implications of what we're suggesting in these various ideas. And so as a part of this hearing, which is unprecedented in many ways because of the circumstances, it is both, I want the tone of it to reflect both a welcoming tone in light of the ideas that have been suggested, but also one that's probative, that we examine thoroughly these ideas and what the implications are. Inaction is not an option, in my view. That may be an option for some. It's not for this chairman. I don't believe we can do anything and just watch events unfold. I think we have a responsibility to respond. I think the notion of fresh capital is critically important, and we need to act expeditiously, in my view, on how we do that. And so I begin the process by suggesting to you that we have a good discussion here over the next hour or so, if we can, with my members who are here, to engage in this debate and discussion. In a sense, I must say at the outset here that the plan, Mr. Secretary, that has been posed is somewhat ironic in a way, in that for much of the last year or so, those of us who have offered some ideas on how to prevent foreclosures have been labeled as costly bailouts for our ideas. Now, I know that's not the view of everyone, but certainly there were those who suggested that was the case. We've also gone through the period over the last year or so when this problem became most poignant, of going from basically this will correct itself, it's not that big a deal, and those were the comments almost a year ago, to the point where obviously we're talking about some unprecedented ideas and suggestions as to how we might move in all of this. And let me just identify, if I can, as part of this, the plan and idea that raised some questions. There are those who suggested what we're looking for here, or what the proposal would be, amounts to a blank check to buy GSE debt and stock. That could spend an unlimited amount of public dollars to buy such debt and stock. The only limitation seems to be the duration of the plan, at least as some have raised. Purchases would be exempt from the debt ceiling, off budget, concerns about that. The Fed would be consulted. We've been talking already some questions to the chairman about the role of the Fed in all of this. The bill that's pending now in resolution between the House and the Senate, and I'm grateful again to those of you here that have been supportive of what we tried to accomplish here, establishes a very strong regulator for the GSEs. There are those, I'm included here, that would be concerned about, in a sense, substituting that very strong regulator, and I say this respectfully, to the chairman of the Federal Reserve, given the authority that's being suggested over that strong regulator, making the regulator far weaker in many ways than I think what many of us would like to achieve and see. There's concerns about that as well. And then, of course, there's the proposal that would as I say, basically dealing with the Fed and giving that power a stronger role than would otherwise be necessary. So those are some of the concerns that have been raised. Obviously, this is an important moment, an unprecedented moment, as I said a moment ago, that we need to grapple with and deal with. And we're, again, deeply appreciative of your presence here, to be probative, to be supportive of good ideas that will move us in the right direction. I think it's very important that we not contribute to the fear, unwarranted fear, I might add, that exists in too many places. This is a time for calm, for stability, for solid ideas that can get us back on the right track. And with that, I thank you for your presence here. Let me turn to Senator Shelby.
Thank you, Mr. Chairman. I'll try to be brief, but I think this is perhaps one of the most important hearings we've had in the Banking Committee, and we've had others. We will now, as you mentioned, will focus on a very important topic, preserving the viability of our nation's government-sponsored enterprises. These entities must be financially strong if we're to work through the housing market correction. Their vitality is also crucial for the future of our capital markets and the economy as a whole. This committee, right here, has worked for a number of years to strengthen the regulatory system governing Fannie Mae, Freddie Mac, and the Federal Home Loan Bank system. Some years ago, as chairman of this committee, I presided over the banking hearing, a markup of GSE legislation that would have created a strong regulator with the authority to assess the risk posed by the enterprises to our financial systems. At that meeting, I noted that should one of these institutions encounter significant financial difficulty, the consequences could be grave for the entire economy as well, perhaps, as the American taxpayer. Regretfully, that legislation was opposed by those who argued that a strong regulator would endanger the GSEs by undermining their financial fundamentals. Goodness, I hope it is now clear that quite the opposite is true. In recent days, market volatility, as everyone here knows, has affected both the debt and equity holdings for Fannie Mae and Freddie Mac. In response, various public officials have made statements regarding the financial conditions of the GSEs. In particular, an OFAO statement noted that both Fannie Mae and Freddie Mac hold adequate capital in excess of the statutory minimums, which is probably true. The GSEs have large liquidity portfolios, access to the debt markets, and over $1.5 trillion in unpledged assets. Many would thereby conclude, and many have stated publicly, that each GSE is safe and sound. Goodness, again, if the enterprises are operating in a safe and sound manner, it begs the question, what are we doing here today? Well, we all know why we're here. Over the years, the debate over GSE reform included a great deal of controversy regarding the topic of systemic risk raised by the Federal Reserve Chairman and others before him. In other words, could a GSE judged to be operating in a safe and sound manner pose a broader systemic risk? For some time, a lot of us have argued strongly that it could. I hope recent events have resolved the debate on this question. The GSEs, even when they are deemed safe and sound, can pose systemic risk. We would not be here today discussing taking unprecedented action to shore up their financial condition for the broader purpose of protecting the overall economy if that were not the case. The administration is now proposing, and we will hear in a few minutes from Secretary Paulson, additional statutory changes in response to developing market conditions. The proposal we will hear about this morning should raise a number of serious questions for the members of the Banking Committee in the U.S. Senate. If Congress intends to reaffirm Wall Street's view that the American taxpayer stands behind the GSE's debt, we will undoubtedly harden the so-called implicit guarantee. If that is the case, I think this committee needs to fully understand why this step must be taken. What exactly would we be getting in taking an ownership stake or something like it in the GSEs? What rights would the government possess as an owner or a guarantor? What impact would such actions have on the dollar and the broader economy, both now and in the future? Mr. Chairman, I hope that our hearing today provides the committee with answers to some of these and other important questions. I hope we can take what we will learn today and make whatever changes to any legislation bill that we deem necessary. I fear that we're sitting on a financial powder keg. Thank you.
Thank you very much, Senator Shelby. And again, let me turn to you, Secretary Paulson and Chairman Cox. We thank you both for being with us. Secretary Paulson.
Okay. Good afternoon, everyone. Thank you very much, Chairman Dodd and Senator Shelby and committee members for your leadership and for the opportunity to discuss these very important issues on short notice. As you know, our financial markets have been experiencing turmoil since last August. It will take additional time to work through these challenges, and progress has not come in a straight line. However, our financial institutions are repricing risk, deleveraging, recognizing losses, raising capital, and seeking to improve their financial positions. And policymakers and regulators are vigilant in their efforts to address the current challenges. Fannie Mae and Freddie Mac, two of the government-sponsored enterprises, the so-called GSEs, are also working through this challenging period. Fannie and Freddie play a central role in our housing finance system and must continue to do so in their current form as shareholder-owned companies. Their role in the housing market is particularly important as we work through the current housing correction. The GSEs now touch 70% of new mortgages and represent the only functioning secondary mortgage market. The GSEs are central to the availability of housing finance, which will determine the pace at which we emerge from this housing correction. In addition, debt and other securities issued by the GSEs are held by financial institutions around the world. Continued confidence in the GSEs is important to maintaining financial system and market stability. Market stability and support for housing finance are among my highest priorities, and they have been for some time during this period of stress in our markets. Therefore, after consultations with the Federal Reserve, OFAO, the SEC, and congressional leaders, we are asking Congress, as it completes its work on a stronger GSE regulatory structure, to also enact a three-part plan to address the current situation. Our plan is aimed at supporting the stability of financial markets, not just these two enterprises. This is consistent with Treasury's mission to promote the market stability, orderliness, and liquidity necessary to support our economy. Our proposal was not prompted by any sudden deterioration in conditions at Fannie Mae or Freddie Mac. OFAO has reaffirmed that both GSEs remain adequately capitalized. At the same time, recent developments convince policymakers and the GSEs that steps are needed to respond to market concerns and increase confidence by providing assurances of access to liquidity and capital on a temporary basis if necessary. The plan we announced will strengthen our financial system as we weather this housing correction and establish a new world-class regulator for the GSEs. It has three parts. First, as a liquidity backstop, the plan includes an 18-month temporary increase in Treasury's existing authority to make credit available for the GSEs. Given the difficulty in determining the appropriate size of the credit line, we are not proposing a particular dollar amount. Flexibility is the best means of increasing market confidence in the GSEs and also the best means of minimizing taxpayer risk. Second, to ensure the GSEs have access to sufficient capital to continue to fulfill their mission, the plan gives Treasury an 18-month temporary authority to purchase, only if necessary, equity in either of these two GSEs. Let me stress that there are no immediate plans to access either the proposed liquidity or the proposed capital backstop. If either of these authorities is used, it would be done so only at Treasury's discretion, under terms and conditions that protect the U.S. taxpayer and are agreed to by both Treasury and the GSE. I have for some time urged a broad range of financial institutions to raise capital, and at Treasury we have constantly encouraged the GSEs to do just that. In March, at my request, both the chairman and the ranking member of this committee hosted a meeting with me and the CEOs of the two GSEs where they agreed to raise capital, and you began the current effort to move your GSE reform bill, which is now hopefully to be enacted with modifications we are recommending today. Third, to help protect the financial system from future systemic risk, the plan strengthens the GSE regulatory reform legislation currently moving through Congress by providing the Federal Reserve authority to access information and perform a consultative role in the new GSE regulators process for setting capital requirements and other prudential standards. Let me be clear. The Federal Reserve would not be the primary regulator. As I have said for some time, the Fed already plays the role of de facto market stability regulator, and we must give it the authorities to carry out that role. This role for the Federal Reserve with respect to the GSEs is consistent with a recommendation made in Treasury's blueprint for a modernized financial regulatory structure. Clearly, given the scope of the GSE's operations in world financial markets, a market stability regulator must have some line of sight into their operations. We have long maintained that the GSEs have the potential to pose a systemic risk and worked with Congress on legislation to create a GSE regulator with authorities appropriate to the task and on a par with other financial regulators. We must complete this work. The Senate passed GSE reform legislation last Friday, and we urge the House to act quickly to advance this process. As I have said, we support the current shareholder-owned structure of these enterprises. Our plan addresses current market challenges by ensuring, on a temporary basis, access to both liquidity and capital, while also ensuring that the GSEs can fulfill their mission, a mission that remains critical to homeowners and home buyers across the country, especially during this housing correction. I look forward to working closely with you, your colleagues in the House, and congressional leadership in both chambers to enact this plan as part of a complete legislative package as soon as possible. Thank you, Mr. Chairman.
Thank you very much, Mr. Secretary. Chairman Bernanke has already indicated, made a statement earlier, and does not have a statement to make at this point. Is that correct, Mr. Chairman? Chairman Cox.
Thank you very much, Mr. Chairman, Senator Shelby, and members of the committee for this opportunity to describe the SEC's actions to deal with the recent developments in our financial markets. Since the credit market crisis began with the deterioration of mortgage underwriting standards and a contagion of abusive lending practices, and then spread to the capital markets through securitization, the SEC has used its law enforcement and regulatory powers to contribute to orderly and liquid markets. We've acted in three main areas: the investigation and prosecution of violations of the securities laws, the regulation of problem areas in the markets, including credit rating agencies under recent authority granted to us by the Congress, and accounting and disclosure standards in order to bring hidden risk into the light. Our work in these areas has been both national and international. First and foremost, the SEC is a law enforcement agency. Our enforcement actions to address the capital markets turmoil have involved not only our Division of Enforcement and each of the agency's 11 regional offices, but also nearly every major SEC division and office and every area of professional emphasis through our agency-wide subprime task force. We are also working closely with other federal and state regulators. The SEC has over 4 dozen pending law enforcement investigations in the subprime area. They are focused on the activities of subprime lenders, on the roles of credit rating agencies, insurers, investment banks, and others involved in the securitization process, and on the banks and broker-dealers who sold mortgage-backed investments to the public. As one example of these initiatives, just a few weeks ago, the Commission brought enforcement actions against 2 portfolio managers of Bear Stearns Asset Management, whose hedge funds collapsed in June of last year and caused investor losses of over $1.8 billion. These cases and others like them in the subprime area are making it clear that vigorous investor protection extends to hedge funds, which are by no means unregulated when it comes to fraud. The same vigorous commitment to investors extends to our jealous protection of the integrity of public disclosure. Because the reliability of information about public companies is so important to market confidence, there have long been clear rules that prohibit market manipulation by knowingly spreading false rumors. But for the entirety of its 74-year history until 2008, the Commission had never brought an enforcement action of this kind. It is probably because of the difficulty in tracing where a false rumor starts and proving that it was knowingly false that these cases haven't been brought in the past. But now the same technology that instantly spreads rumors around the globe is also helping law enforcement track down the culprits. As a result, just a few weeks after the demise of Bear Stearns, we successfully sued a trader who used instant messages to other brokerage firms and hedge funds to spread fake information about a pending acquisition. The false rumors that he started caused the stock to drop by 17% and caused a wipeout of market capitalization of $1 billion in 30 minutes and led to a halt in trading of those securities on the New York Stock Exchange. Following our enforcement action, the Commission not only hit the trader with penalties and other sanctions, but also banned him for life from the industry. This was a landmark case, and it will not be unique. If we are successful in bringing future cases like this, I believe the penalties should be commensurate with the enormous amount of shareholder value that is destroyed by this kind of wantonness towards other people's money. For several months, we've had other active investigations underway concerning the possible manipulation of securities prices through various combinations of manufacturing false rumors and short selling. In addition, the Commission has joined with other securities regulators in undertaking industry-wide sweep examinations that will include hedge fund advisors, aimed at preventing the spread of intentionally false rumors to manipulate securities prices. In addition to enforcing our existing regulations, the Commission is also using our authority to promulgate new rules. Today, the Commission will issue an order designed to enhance protections against naked short selling in the securities of primary dealers, Fannie Mae and Freddie Mac. The emergency order will provide that all short sales in the securities of primary dealers, Fannie and Freddie, will be subject to a pre-borrow requirement. In addition to this emergency order, we will undertake a rulemaking to address these same issues across the entire market. We are also using our new authority under the Credit Rating Agency Reform Act to write sweeping new regulations that will apply to the rating of structured investments. Until the passage of this landmark legislation, the credit rating industry was largely unregulated. Now, in the 10 months since the first firms became registered under the new law, they are subject to thorough and ongoing regulation of everything from their public disclosures to their management of conflicts of interest to their ability to prevent unfair, abusive, or coercive behavior in the ratings process. The new law also gave us the authority to examine these firms, and we are using it aggressively. As you know, we recently provided to the committee a complete report of our staff's findings in these examinations. The subprime crisis was also deepened by problems with disclosure and accounting, and so in recent months we have asked financial institutions to provide additional disclosure regarding both off-balance sheet arrangements and the application of fair value to financial instruments. And last Wednesday, the Commission held a roundtable to hear from market participants and regulators about the challenges of current fair value accounting and auditing requirements, which will provide the basis for potential new guidance from the SEC, the FASB, and the PCAOB. Since the events of mid-March that culminated in the Bear Stearns acquisition, the SEC has broadly engaged with other regulators on issues related to capital and liquidity. We've broadly strengthened liquidity requirements, and we are closely scrutinizing the secured funding activities of each CSE firm. Working together with the Federal Reserve, we've developed additional stress scenarios in light of the Bear experience. These scenarios entail a substantial loss and assume no access to the Fed's liquidity facilities. Our recently concluded Memorandum of Understanding with the Federal Reserve Board is facilitating this cooperation, as well as our joint work in a number of other important areas. Finally, I note that the subprime crisis has affected markets not only here in the United States, but all over the world. And so we have been working closely with our international regulatory counterparts to ensure that our solutions to these problems work across national borders and in other markets. Thank you again, Mr. Chairman, for this opportunity to discuss these important issues, and I'll be happy to take your questions.
Thank you very much, Mr. Chairman, and we appreciate your presence here again today. Let me I'll put 6 minutes on the clock here, and we'll move along. I'm going to stick, because everyone's shown up here, we'll move in a normal seniority system here as everyone's been here for the last 2 or 3 hours. Let me address, if I can, the very points Mr. Secretary have raised. And again, this is our responsibility here to be probative and examine these ideas, particularly if we're going to try and act in some expeditious fashion here. Normally there'd be a period of time to really go over these issues in far greater detail, but the sense of urgency is something I think all of us, or at least most of us here, appreciate. Let me begin by first of all, asking a quick series of questions regarding the issue of the lines of credit, and then I'll get to the issue of stock, and then the issue of the regulator, if I could, quickly. One, you're seeking an unprecedented grant of authority to purchase GSE debt and stocks. What kind of assurances can we offer taxpayers that because we don't have a number here, this is an unlimited amount we're looking at potentially? What has happened with the $2.25 billion? The present authority exists from the Federal Reserve. Why aren't we going and just opening the discount window? Institutions that have access to the discount window, and Chairman Bernanke can respond to this as well, use GSE debt as collateral, as a basis of qualifying for borrowing at that discount window. If we do that, why not allow these GSEs to have direct access? That way we don't need new legislative authority and would provide that kind of fresh capital we're looking at. Why not just go that route if we're looking for some quick action here that would reassure the markets that there'll be adequate capital?
May, Chairman, answer that question. First of all, in terms of the size, as you know, when the GSEs legislation was set up in 1971, there was a direct line of backup credit provided by Treasury of $2.25 billion for each agency. At that time, I saw Freddie Mac had capitalization of $1 billion. Why are we asking for an unspecified amount? And the reason we are is I have the same objective that you have. What I would like to do is provide stability in the market and do so at the least cost to the taxpayer. And I see it very clearly that the way to minimize the chance that this facility will ever be called upon will be to take any questions off the table and to provide as much flexibility as possible. Now, to your question relative to the...
Let me just interrupt. We're taking the big question we're going to be faced with our constituents is, how much is this going to potentially cost us?
Yeah, and as I've said, since we believe that the right thing to do is to keep these institutions in their current form, the question which I'm answering is that this is a backup facility, hopefully would never be used. And if you want to maximize the chances it'll ever be used, you would have maximum authority for a temporary period of time. We're asking for it for a temporary period of time. All I can do is tell you, which in my judgment, what I believe is the best for providing stability, providing confidence, and minimizing the chance that it'll be used, and minimizing the chance that people will lose confidence and draw down the backup facility. Now, in terms of the
why not just the discount?
In terms of the Fed has a number of other very important priorities, and what the Fed did here, which was, and I'm very grateful to the chairman and for the federal board, because what they said to me was they said, Hank, if you can, through your consultations with Congress, develop a plan, and you believe based upon your conversation with the leaders, and as you know, I talked with many leaders of Congress, and you can get some buy-in in advance that something like this might be acceptable, then we would be willing to provide a backup while we're waiting. But I guess the question the way I would throw it back at you, the Fed has their lender of last resort responsibilities. That's unspecified. Why is it unspecified? It's unspecified because it increases the confidence. Congress, in their wisdom, set up the Treasury is providing the backup facilities here. That's what the authority is. They just haven't been updated in a long time. So that's why we proposed I consulted with Congress. We proposed this. We think this is the best way to limit the cost to the taxpayer. And again, I'm very grateful that the Fed agreed to be there, providing the backup while we're waiting for Congress to act.
Let me ask Chairman Bernanke this. As I understand it, in the past, there's been some willingness to allow access to the discount window if the $2.25 billion authority lines of credit has been exhausted. Once that's exhausted, then the possibility of having access to that discount window becomes available. Is my understanding that correctly?
Yeah, right. I would say that is, you look at that as sort of a normal working of government. I provided that, we provided that to the chairman in the interim, but it was done with the understanding and the way I worked with the chairman over the weekend was we worked through the weekend, we consulted. I told him I'd made the various calls I had made, that I was optimistic that we would persuade Congress that the backup facility should be increased, and then on that basis he went and agreed to fill it in this period.
Well, let me ask Chairman Bernanke the question. Why not? In fact, if the GSE debt can be used as collateral for other institutions that come and have access to the window, why not allow the GSEs to have access directly to that?
I think the reason it has to do with who sets the criteria and makes the decision. The Federal Reserve's lender of last resort function is a very flexible tool that is very important because we can use it quickly in unanticipated circumstances and provide liquidity in situations where it's needed. When a policy has potential fiscal implications, it's far better, if time and circumstances permit, to have the fiscal authorities make that decision. So I think it's really appropriate for the Treasury Secretary, not in consultation with the Congress, and not the Federal Reserve Chairman, to make those decisions. And that's why I would believe it would make more sense to be the responsibility of the Treasury Secretary.
Is there any question in your mind that you have the authority to make that window available to the GSEs if you so decided to do so?
We do have the authority, although we have a regulation we'd have to address which says only under economic circumstances that are stressed. But again, I do think that that the lending and the decision making ought to be lodged with the fiscal authorities. I would point out that what the Secretary is proposing is not a simple expenditure. Either a liquidity provision or an equity purchase is a loan or an investment that has an asset on the other side. So it's not quite the same thing as a simple fiscal expenditure. It is a loan, as the government makes in many contexts, or an investment.
My time has expired. Senator Shelby.
I want to pick up on what Senator Dodd was talking about. Secretary Paulson, just take us through slowly, step by step. What is the proposal that you have set forth as to deal with the GSEs, and what is the potential cost to that? Because this is not an empty gesture. I think you mentioned a minute ago and used the phrase, they might not need this, they might not use this. This would be the best of all worlds, but what if they did? Let's go through the steps of what you're proposing so we can understand this fully. I think it's very important.
Senator, I want to start off with something you said, which was essentially we didn't design this, we're playing the hand we're dealt, right? And as I see this, that what we've asked for, and I'll go through them again, is first of all the authority for a temporary period of time, authority for 18 months.
What do you mean by temporary? How long?
18 months, and I would like to talk about that for a minute, because we asked what's the right period here. And it seemed to me that we didn't want to I could have asked for it for the end of the year. It didn't seem like we don't know what the markets will be like at the end of the year. It didn't seem like a great gift to give to my successor, whoever he or she may be, to have something like this expiring right away. And so as we thought about it, we said 18 months or through the end, I guess we said through the end of 2009. That should give time to get the new regulator established, to work through this current, period of turmoil, to have the new administration give them some time to assess the situation, give them some time to work with Congress, give you all time, and so that was where we came up with the asking for it until the end of 2009.
How much money are you contemplating here?
Well, again, there is, I would say with that, there is no current plan, and it would be the expectation with a facility like this that, again, a backup facility is about confidence. And if you want to make sure it's used, make it small enough, and it'll be a self-fulfilling prophecy. And so, again, all I can do is say to you that while I'm here, I would ask for it to be unspecified, and I would plan on doing what you found I've done and everything else, which be consult extensively. The next authority we asked for was the authority at Treasury's discretion, but also given the engagement and mutual support of the GSEs, that Treasury would have.
Is that open-ended? Is that
again? That would be for 18. Senator, that's also for 18 months, because I again think that as I look at this proposal, I believe what we've got here today is something to address the short term and the long term. I'm going to get to that in a minute. So I think we've got a proposal that's going to address the short term issue and the longer term. So with regard to the again temporary authority, and while I'm here, again, I would plan on consulting with you and the other leaders here before exercising that authority. But I would.
The word consulting you're using here, is any ambiguity to that?
Well, yeah, I would not like it to be a legislative requirement, and the reason I wouldn't is, again, I think to the extent you limit it or take away the flexibility, it then makes it worth less in the marketplace. But again, the authority to make an equity investment if it's deemed necessary. And again, if that were done, it would be done with the appropriate protections for the taxpayer. And then, of course, the third, let me just get...
You go ahead. It's your fault.
Then I'll just say the third thing, because you asked for all three, and I think this is important here, because we've all been working, and you, Senator, have been a champion in this area. We've been working to get reform with a world-class regulator. And I think that when that regulator is in place and that regulator is up and going, I think there will be a real opportunity to have the discussion for what's the right size, what are the risk characteristics, capital requirements, business activities. And so I think you're going to be able to address the longer term, and this also addresses the short term.
Secretary, what's the trigger? At what point, in other words, would Treasury exercise this new authority? And what if, for example, if the equity price falls below $1? We know the consequences of that, I think. Or if debt cannot be issued, or is it at the too wide a spread over the treasuries? In other words, a lot of these events occur.
Yeah, I
want
think
to reserve that.
Well, I think just for that, Senator, you've laid out the reasons why it would be self-defeating to start putting limitations on that. So I think the way I would see that and the way I would like it to work is temporary, and the understanding you would have with me, although we wouldn't have, legislative requirements, the understanding you would have with me, this would be something that I would talk about with leadership of this committee and committees in the House before, and it would be, if needed. And just remember, as you said in your opening statements, the regulator who we have confidence in has said they're adequately capitalized. The market is saying they've got concerns. And so one way of reassuring the market and being ready to respond is to say that, and again, with the objective of market confidence and having the GSEs play that role, which is so important in our housing market right now.
Are you basically saying that this is a temporary involvement by Treasury? It's not open-ended, but it is an involvement to reassure the markets and protect the downside.
Right. I'm saying the first two is exactly right. You said it very well. Temporary, protect the downside, and to make sure that these entities continue to play that role we're going to need to play to get through this housing downturn. And the third part of this, which is, the strong independent regulator, that's permanent. And that will be, and so as I said, this addresses the short term and the long term.
Thank you, Mr. Chairman.
Thank you very much. Let me turn to Senator Carper.
Thank you, Mr. Chairman. I want to go back about 28 years, and we were concerned here. I was State Treasurer of Delaware at the time, but we were concerned about the failure not of GSEs, but the failure of one of the big three, Chrysler Corporation. And I remember Lee Iacocca calling on the Congress, calling on the President to provide assistance. And what we did in my state and a number of states, we negotiated a loan to Chrysler, collateralized loans, which we made and ultimately earned interest on. We actually made money on those loans. Here in Washington, there was an agreement negotiated with Chrysler which involved, I think, warrants, which could ultimately be exercised. And at the end of the day, Chrysler survived, and I believe the federal government actually made a dollar or two on the deal. I don't believe there was a great anticipation 28 years ago that would happen. We were hopeful that Chrysler would survive. The fact that the money was made on the warrants and also on the loans from that we made from our states was, if you will, the icing on the cake. What is there's a lot of concern here, rightfully so, of the exposure that we put our taxpayers to and the Treasury to by virtue of going down this path. Is there any upside, aside from the fact that we want the GSEs to survive, we want them to be there when the economy, when the market bottoms out, when all those renters across the country said this is the time that they want to start buying a house. And I think that will happen, hopefully sooner rather than later. But there's another upside other than making sure that our mortgage markets are prepared and our housing markets are prepared for that recovery.
Yeah, Senator, let me mention two things. First of all, the big upside is every homeowner in this country, or everyone who wants to buy a home or wants to refinance a home, refinance a mortgage, benefiting now. But let me also explain that unlike the Chrysler situation, and I'm old enough to have been around to remember it, this is not what we're recommending. These organizations are very viable. They're playing a very important role. And what we're doing is, I'm not here recommending putting taxpayer money in these institutions at this time. I'm here recommending that we increase on a temporary basis the backup facility to provide the confidence to the markets and to minimize the chance, greatly minimize the chance that the taxpayer would be involved there, and here also to reassure and say that we have the capacity, again, for a temporary period of time to make an investment if it's needed and if it's at our discretion and the GSE's agreement, then if that, and only then if that investment is made, but will it be made on terms where hopefully will protect the taxpayer along the lines that you talked about. But the overriding issue here is the confidence in our capital markets more broadly, our financial system more broadly, the stability of our financial system more broadly, and the fact that the GSEs really right now, this market is the only really working secondary market in housing finance in our country today.
One of the proposals that you've suggested is an increase in the Treasury line of credit for Fannie and Freddie. And I have some concerns, and I suspect my colleagues do too, about having no cap, no limit at all. For some of us, it sounds a little bit like a blank check, and I know that's not the intent. A second recommendation that you have is that the Treasury be authorized to purchase the stock of Fannie and Freddie. If you ultimately do that, and if the value of the stock does go up, is there some potential for the Treasury actually making money on this deal?
Let me say two things. First of all, your comment about the blank check. I think I've answered that before.
I know you.
I hope you understand what I've said.
I did.
And I know it's if people haven't thought about these issues for the long time, it's counterintuitive. But really, the greater the confidence, the less likelihood that the taxpayer is actually going to pay.
And I agree with that.
And secondly, I can assure you that if we decide to make an equity investment in these institutions, we will do so to protect the taxpayer, and it would, I would believe there would be, but we'd have to talk about that at the time. But obviously,
let me interrupt because my time is limited. Let me just interrupt. So you don't think several years down the line, when the shares that the Treasury has bought in Fannie and Freddie turned out to be a windfall, and we're able to balance the budget, there won't be you won't be heralded and saluted for the role that you played in that?
Again,
I say that with tongue in cheek.
Well, again, what I'm saying is, because I really do need to be clear, there isn't a plan to do that at this time. I would sure hope, like you, that if there is one, that as our markets recover, and if the shareholders put money in, they end up making a lot of money, as was the case in Chrysler. But remember, this is not Chrysler, and there's not a plan to put equity in these institutions at this time.
And if I could just one last quick question. I think you're proposing a more formal role for the Federal Reserve, working in conjunction with the new GSE regulator. How would that work?
Okay, because I think this is important, and it's something that we've thought about for a long time, and when we suggested it, that other countries, the UK has taken this up with their central bank. I need to step back and say, if you really look at what the market has come to expect, they've come to look at the Federal Reserve and saying, if there's an issue that threatens market stability, we expect them to play a role. And so one of the things we've asked is not that they supplant other regulators, not at all, that they have but have asked that they have some line of sight, they have a visibility, and they're able to play a consultative role. So and it's only fair when you look at what, and fair to our country, what might happen. And so this, to be very specific for you, this is not designed in any way to undercut the authority of the new regulator. This regulator has got to be world-class, got to be a strong regulator. You will be working with a new regulator. You will be working with a new regulator to address the issues that so many people have talked about. But I would warrant that you and other Americans and people around the world will feel more confident. I sure will, knowing that the Fed is there to play a consultative role and be able to give their comments also, and that's the purpose.
All right, thanks so much.
Thank you very much. Senator Bennett.
Thank you very much, Mr. Chairman. Mr. Secretary, going to your testimony on the second page, you say, let me stress there are no immediate plans to access either the proposed liquidity or the proposed capital backstop, and you've made that very clear, and I think appropriately so. Then this sentence, if either of these authorities is used, it would be done so only at Treasury's discretion under terms and conditions that protect the U.S. taxpayer and are agreed to by both Treasury and the GSE. Can you help us understand a little bit more the specifics of the terms you have agreed to with the GSE? Or are there any?
There are no terms, because we haven't, as I said, there's no plans to use it as yet. I said if needed, and so if needed, and we would obviously be consulting, and we would look to work something out that was mutually agreeable, but it would have to be, you know, on terms that would protect the U.S. taxpayer. And so I can't. It was a little bit like Senator Shelby said, that you could think of so many contingencies or what ifs.
Yeah.
It'd be pretty hard to design those terms, you and I sitting here today.
Well, I'm assuming if the GSEs felt, okay, we are in trouble, and then they came to you, that would be the triggering event that would cause you to look at it?
That could be one triggering event, absolutely. It could be another triggering event that we are the marketplace. Could be a triggering event. But so I wouldn't want to say to you the only basis on which we would talk to the GSEs about capital is if they came to us. Now, my own belief, and let me say,
yeah, I assume you'll be in conversation.
Yeah, let me say we've been, and I just would compliment. I just want to say something about both of these organizations. I agree with Senator Shelby that there's systemic risk, and no one today who's looked at this could argue that there isn't. But I would also say that when you look at the way they've run their operations, the reason we have these issues is they've got one line of business, there's been a housing correction. I would say that their standards and underwriting standards as we've gone through this period have been good relative to what we've seen many other places. And I would also say that they've worked with me, not only over the weekend, but leading up to the weekend in a very constructive way. And so I would have every belief that the question you asked would play out, that we would be in dialogue, we'd be in consultation. I think it will be very unusual if we suddenly say, we think you need equity and no one else does, okay? I think this is something that we would work on together. But again, to protect the government, I can't say that the only trigger is the GSEs come to us and ask for it and we give it to them. You wouldn't want me to do that.
I understand that. And your discretion means they come to you and ask for it, you may say no. Yep. That could also be a possibility.
My discretion, that's right. I mean, we may say no, or we may say these are the terms we think, but I think what you're going to find is it's got to be at our discretion. I was very clear with them when we talked over the weekend that this wasn't going to be something that we were going to be forcing on them. This would be something we'd have to work on together, and it would be done mutually.
That's what I wanted to get clarified, and I think you're in exactly the right place. Chairman Cox, I was interested in your comment. You'll not be surprised when I raise this, given our past history on the issue. I was interested in your comments about naked short selling and the steps that you are taking. I want to commend you. Your staff has been to see me with a list of all of the steps they are taking with respect to naked short selling. I want to stress again, I'm not opposed to short selling. Short selling is an essential part of maintaining an orderly market, but I am satisfied that there are circumstances where people sell short without, in fact, having located the stock that they are selling short, and then hope that the confusion of the marketplace covers up that fact and that they never get the failure to identify the shares that they're selling short never catches up with them. And I congratulate you on the work that you've done there. May I make a suggestion? And this comes out of a completely separate kind of experience, but as I watched the Winter Olympics in Salt Lake City, I discovered something that I had never understood before. At the end of a luge run, or a bobsled run, or whatever it might be, before the athlete gets out of the luge, he reaches into a basket that is filled with colored balls, and he pulls out a ball. And it's orange or red or whatever it might be. If it's black, the athlete is instantly taken to a place where there is a drug test, so that the athletes know that there's always the possibility, even if it's completely random, that he or she will be subjected to a drug test. Might I suggest that you set up a SWAT team of some sort that can drop into a brokerage house completely unannounced, completely at random, on no particular tip, to simply say, we want to pick out a couple of stocks and look to see if within your brokerage house somebody has been engaged in naked short selling. And it's completely random. You walk away with an orange-colored ball or a red ball and whatever. You are completely clean. There's no stigma attached to it. But I think the people who are engaged in naked short selling might be a little nervous if they thought there's a dozen people in the SEC that just might show up at our doorstep and start looking at this kind of thing. So I use the opportunity of your being here to make that suggestion to you, even as I commend you and your staff for the great strides you have made in this area in the past.
I thank you, Senator, and as I mentioned, in addition to the emergency action that we were taking today, which will have a 30-day life, we are also contemporaneously going to be starting a rulemaking focused not only on the primary dealers and on Fannie and on Freddie, but on the broader market. And in that connection, the kind of sweep examination that you were talking about, which is part and parcel of what the SEC routinely does, will help inform our decisions. And so I very much appreciate your suggestion.
Thank you very much. Thank you, Mr. Chairman.
Let me underscore that point as well. And we had a conversation over the weekend, and I hopefully just the mere announcement of where you're moving may have the desired effects. If we're talking about just announcing things can have certain implications, I think this is very smart and very wise. And I remember very distinctly in our hearing on the Bear Stearns J.P. Morgan Chase, I think I'm quoting you exactly when you were asked the question, I think by John Tester may have been, on this matter. You said certain matters are too big to miss. And we appreciate the fact that the agency seems to be responding to that.
We've been very busy on this for many months, Senator.
Senator Menendez.
Thank you, Mr. Chairman. Thank you all for your testimony. I hope we've been listening to the three wise men of the economy here, and what you're telling us is going to steer us in a different direction. But I have some concerns. You know, I have, in the past at some of these hearings, suggested that we seem to be behind the curve instead of ahead of it, that we seem to be constantly reactive instead of proactive. And I'm just wondering, you know, we seem to be in a pattern that's developing where our regulators suddenly realize an emergency on a Friday and then hastily formulate a rescue plan at the 11th hour during the weekend. We saw this happen with Bear Stearns, and now we're talking about this as it relates to Freddie and Fannie, and we saw what happened to IndyMac. And I'm just concerned that what we have here is the equivalent of last-minute cramming style of regulatory action, and that puts us in a process of expediency over well-thought-out policy. You know, I wonder, Mr. Secretary, how is it that, knowing what's happened with reference to companies that have been shaken dramatically, that have securitized loans over the past year, why we thought that Fannie and Freddie would be insulated from the very same market conditions that have crippled other companies that specialize in loan securitization. That's one question. The second question is, I hear you when you say that it is your intention or desire and hope not to use the very power that you are asking for, but I am concerned, all of us here play a fiduciary role to the taxpayers, not only of our states and the country. And as you just mentioned a moment ago, it is counterintuitive to say, give us a blank check or a blank authority as the best way to ensure that taxpayers aren't on the hook. That is certainly counterintuitive. And the difficulty is, having just seen the Bear Stearns process that we went through, where it has now had about $1 billion of asset loss since March, which now puts us into the area where, in fact, the federal government, i.e. the taxpayers, begin to come into play in terms of responsibility for picking up the tab if this decreases further. I know it's not your intention to use it, but by the same token, there is no safeguard under your proposal for us to create some limits of those liabilities should you have to use it. And finally, I'm concerned about that while I know it's not your intention to use it and you think that this is the best way to avoid taxpayer liability, just look at what Wall Street basically did in terms of when the plan was announced. It pushed Fannie's stock up more by 20%, Freddie by more than 15% in early trading, and then it closed down 8%, and Fannie was off 5% at the end of the day. So it almost seems to be saying, they seem to be saying it's just not enough. So do they want some guarantees here? And if you want guarantees, that means more than just the possibility of, for 18 months, it may mean more. So I hope you can address those issues. Why did we not see this possibility coming? How is it that, in fact, we go back and tell the taxpayers there's absolutely no way you're going to be put on the hook here? Thirdly, when we've lost $1 billion already in the Bear Stearns process. And then finally, let me put the last question out there and let you answer it. It would be to Chairman Cox. I appreciate that you said, first and foremost, the SEC is a law enforcement agency. And I appreciate a good part of your written testimony talking about going after market manipulation, where in one case the false rumors in Bear Stearns caused the stock to drop by 17% and wiped out $1 billion of market capital in the first 30 minutes and had the stock exchange halt the trading in the company's securities. Can we expect you to vigorously pursue more enforcement activities of that type going in the days ahead? Those are the questions I'd like to hear answers to.
Yes, Senator, let me respond. First of all, on not foreseeing this, I would say to you from the day I set foot in Washington, I started work to get GSE reform. I was told you got no chance of getting it. There are people on each side. It's a holy war, and the best you're going to have is what we currently have. Every time I testified, when I testified before this committee before and I got asked about various housing proposals, I said they're important, but this is by far the most important. Did everything I knew humanly possible to move this through Congress. In terms of raising capital, again, with the authorities we had, which was just really just talking, pushing, even having meetings with the chairman and the ranking member and the GSEs to raise capital. In terms of the plan, it could just as easily have come together during the week as over the weekend. We've been working on this. This was not a Bear Stearns situation. This is something that will be helpful at calming the markets. In terms of the unspecified line of credit, what I meant to say wasn't that it was counterintuitive to sophisticated people who are in markets all the time and used to thinking about it. What I'd said is if you're not used to thinking about these issues, it seems counterintuitive. But if you're used to thinking about the issues, it is very intuitive that if you've got a squirt gun in your pocket, you may have to take it out. If you've got a bazooka, and people know you've got it, you may not have to take it out. You're not likely to take it out. And I just say that by having something that is unspecified, it will increase confidence, and by increasing confidence, it will greatly reduce the likelihood it will ever be used. And then I think that answers the questions. And Chris.
Senator, I think you are absolutely right that more of these cases need to be brought. As I mentioned, they have not been brought in the history of the agency, largely because it has been in the past so difficult to parse where rumors start and where they're just being spread about in our increasingly efficient information society. But the tools that we now have with technology are permitting us to trace back, in many cases, through emails, through instant messages, and so on, to the very individuals that have manufactured intentionally falsely information that's designed to manipulate securities prices, and that goes to the bread and butter of what SEC law enforcement has always been about. Just for the record, I want to make clear that the example that I gave in my testimony of the first ever case that we brought came right in the wake, just weeks after Bear Stearns, but it was not Bear Stearns Securities, it was Alliance Data System Securities, where that $1 billion drop in market cap occurred in 30 minutes as a result of the rumor.
So just one, Mr. Chairman, do you expect to pursue more enforcements of this time?
Yes, we do. This will not be unique, and we have other investigations of this type underway.
Thank you, Mr. Chairman. For the record, as the distinguished SEC Chairman noted, I want to just briefly respond to a comment that Secretary Paulson made in response to the distinguished senator from New Jersey about what happened. I recall 6 years ago, Mr. Chairman, that I worked with then Congressman Baker from Louisiana in the House on GSE regulation, and I introduced legislation based on Congressman Baker's bill. And I could not get one co-sponsor from my party or the other party on this issue. And I was informed by a number of people that this was so far beyond the realm of possibility as we talked then and now are dealing with that reality today, systemic risk, what would happen, would the taxpayers be saddled with this possibility? So Secretary Paulson's answer is correct. In fact, when Secretary Paulson and I first became acquainted, I think the first conversation we had was about this issue. Now, on to other issues, more current in dealing with this reality. Let me ask the three of you, I'm going to read a list of companies that you're all quite familiar with: Citigroup, AIG, Merrill Lynch, Wachovia, UBS, Bear Stearns, Morgan Stanley, MBIA, and there are others. And what do they all have in common? Well, one thing they have in common is that their senior management has taken responsibility for what's happened to each of their company's stock as it has gone down, and we know the rest of the story. Now, here's the question. The current management of Freddie Mac and Fannie Mae, as far as I know, are well compensated. Their board is actually well compensated. And my question to each of you is, how much responsibility should be placed on the management of Fannie Mae and Freddie Mac? We've been gliding over this issue for some time. I have not heard anyone address that today. Maybe someone has. I haven't been here for every minute of the hearing. But should the management be held accountable? We'll start with you, Secretary Paulson.
Yes, I would say, as a general proposition, I believe management should be held accountable, and compensation should match performance. But I would say in these instances, again, these are companies that have a single line of business. It's housing. We have a quite a significant, you'd have to go back a long period of time to see a correction like we've had in the housing market. I believe that their lending standards have not been lax, certainly not compared with many others in the marketplace. The issues that you and I are concerned with have to do with systemic risk and reform and all the things that will be debated with the new regulator. So again, there is no proposal today to inject federal funds in these companies at this time. So, you know, my experience with management has been a constructive experience, and a constructive experience as we're working through this. And my experience with the boards, I would say that we, you know, I talked directly with the Freddie Mac board, did not talk with the Fannie Mae board, but had very good discussions with Dan Mudd, and they all were very constructive. So I'm not looking for scapegoats here. I'm looking to get this done, and I'm grateful for the service that the board members are providing and that management's providing.
Well, I'm going to ask each of you as well. I'm not looking for scapegoats either. I am looking for accountability. Right. And if the American taxpayer,
I know you are, sir.
Mr. Secretary, if the American taxpayer is going to fulfill the plan that you have laid out, if we need to do that, then I consider them investors. Somebody's got to pay the bill. It seems to me accountability somewhere along the line here has to be brought forward, and I understand what you're saying. But this is not a new issue, Mr. Secretary, just as you presented that issue to me when you came to see me when we talked about your confirmation. Mr. Chairman, how do you respond?
Just say one additional thing, yes, because you're right. If and when, and again, there's no plans to do it, but if government funds go in, then I think we need to look carefully at the ways to protect the taxpayer, the appropriate terms and conditions, and think all of that through.
Well, the only comment I'd make of that, then it's too late. Mr. Chairman?
Well, I was going to just say that if the investment is made, just like any investor, there would be terms and conditions, and if management changes were part of what the assessment was at that point in time, then that would certainly be something that the Treasury Secretary would be able to, you know, bring to the table as a possible condition.
Mr. Chairman?
Senator, I'm going to interpret your question as not a difficult one. Management in the private sector needs to be accountable to the board of directors and to the shareholders. And to the extent that both Fannie and Freddie are going to be private companies, the degree to which that accountability exists will be a measure of the degree to which they are successful in that respect.
Well, I've got 30 seconds here over, and I would just add this as I end, Mr. Chairman. The real issue is going to be, should be, and it'll be the next hearing, I suspect. It was reflected in a Washington Post editorial today, which I suspect you all read, The Perils of Paulson. And the real issue is, do GSEs work? I mean, what we're dealing with here just didn't come out of the night, a bolt of lightning. We've been dealing with this issue for the last few years, as far as not what Moody's did today in cutting the preferred and say they may cut it more for these so-called whatever they are agencies. So the question we're really going to be dealing with, the next president, the next set of government managers and regulators, is this a model that works anymore? Because we're not going to be able to keep coming back and back and back to the taxpayer and no confidence in all that now is integrated into this system. Now, that's for another hearing, another day, I understand. But I don't think we can walk away from the larger picture here.
Can I just say, Senator, because you and I agree, and I think there's, as I said, there's two parts to this. One is addressing the current situation, and the other is the long term. And I believe this plan has got both parts, and you get the strong regulator in place, you will have the opportunity. With that regulator, there will be there will be a time and a place with that regulator in place to address all the issues that you want to address. Time in terms of size, risk, business activity. But my comments had to do with the GSEs in the current model, the current form, and I certainly am not looking to be an apologist for management, but I just wanted to say that it would have been surprising to me if there weren't some of these issues, given the size and given what's happening in the housing market when they're in the housing market.
Thank you. I guess it could be a subject of a longer discussion, but let's remind ourselves, this began with predatory lenders out there marketing products that borrowers could not afford. They were never, GSEs, Fannie and Freddie were never bottom feeders. They had some Alt-A, they had some subprime, but nothing to the extent these other institutions had. That's where the problem lay. The failure to actually oversee, to regulate, to monitor that effectively is where the problems began. We had legislation adopted 14 years ago for which a regulation was never promulgated to protect against deceptive and fraudulent practices. Had that been done, had cops been on the beat, taking advantage of going after these people who are marketing these products as they were as aggressively, we wouldn't be here today. This wasn't a natural disaster. This was malfeasance and misfeasance, in my view, that created this mess that we're in today. Senator Reid.
Thank you, Mr. Chairman. Mr. Secretary, recently the Federal Reserve and the Securities and Exchange Commission entered into a memorandum to coordinate their supervision of the consolidated supervised entities. I don't believe there was a specific legislative requirement that they do that, they consult, or anything else. So why is it necessary to have a legislative requirement that this new super regulator consult with the Federal Reserve? I would think it would happen or could happen in the course of the common interest of both regulators. And the downside, I think, has been expressed by some of my colleagues, is if we have a super regulator, if he's looking over his shoulder every moment, even for, as your language requires, even for guidelines or directives concerning prudential management operations, that would involve the Federal Reserve, I think, in the routine decisions on a daily basis.
Well, let me say first things. I think there's something confused there, because it would certainly not be what the role of the Fed we would be suggesting. But let me get back. But let me get back to the specific question. The way the Fed and the SEC have come together underscores a very important point. We have a regulatory structure, in my view, that is outmoded in this country. And it's not just that we don't have a world-class regulator with all the necessary powers for the GSEs. We have a regulatory structure that doesn't work the way we'd like it to work for our financial system today. So while we're waiting for Congress, and it's going to take some time, because these are going to take time to work through these issues and to deliberate, what you've seen is regulators have been able to come together and work cooperatively for the good of the system. And that's what you saw happening with the Fed and the SEC, in consultation with Congress, working together, using the SEC working with the Fed. There is now, while we're putting something in place, and which is hopefully going to be a permanent long-term solution in terms of a strong independent regulator. We've made the case, and I think it makes sense, and for the reasons I've articulated, that not to be the primary regulator, not to look at appointment of directors, but to consult when you look at capital and issues of risk, and to formalize that. And that's what we've, as I said, what we've suggested more broadly, and I think it's a good model.
Well, Mr. Secretary, this is, I think, your language that you, coordination with the Board of Governors of the Federal Reserve, prior to issuing any proposal of final regulations, guidelines, or directives concerning the prudential management and operations, standard and safe and sound operation of and capital requirements, That seems to be a rather expansive consultative process.
When you to consult, again, when you're consulting on prudential issues and capital issues, that's what we would like. And I would like to understand how that could be a negative to have the Federal Reserve, which is our country has come to look at on a de facto basis. And let me say, when the powers that were put in place many years ago, we didn't have GSEs. Our regulatory structure was set up when this country was primarily about banks. And when you look at the importance that other financial institutions play, the thought is strong, independent regulators, but to have one entity that we're looking to anyway for systemic risk to be able to have a line of sight and to consult on matters of prudential regulation and capital. So that's just...
Thank you, Mr. Chairman. Do you have the capacity to consult on a daily basis about directives that this new super regulator will be giving? Or the willingness?
Well, our understanding is, as the Secretary has said, is that there would be a strong independent regulator which would
turn to you
not
for
be the Federal Reserve.
Guidance on directives.
The Federal Reserve already has a good working relationship with OFEO, as do many other regulators. And we are prepared to cooperate, assist in any way that the Congress thinks is helpful.
Well, it seems to me that one of the problems we've seen over the last several months, the regulatory response to many of these issues, was that the Federal Reserve was making statements and giving speeches about subprime. There were different actors, but there was a lot of consulting going on, but there wasn't a lot of regulating going on. I think one of the purposes that we've been striving for these many months is a regulator that, in the military parlance, unity of responsibility and command, that they're the one where the buck stops. And I think we have to just consider this very carefully. I'm not dismissing the merit of having a overarching regulator, but I think we have to look carefully at capacity and also about making sure that the underlying regulator is not constantly looking over the shoulder on operational details, but is consulting where it counts at the top in terms of risk, in terms of systemic risk.
That is the intent here. And again, I would just say to you, and I just feel so strongly about this, that we have a fragmented system and with multiple regulators, and the regulators need to be strong, and we've fought to have this regulator be as strong and powerful as possible. But again, to have a regulator with overarching responsibility for systemic risk, being able to have a line of sight, information, and be able to consult on these very important matters is something that we've recommended, and I believe something that would give the market great confidence.
Thank you.
Senator Bunning.
Well, thank you, Mr. Chairman. First of all, let me tell you, Secretary Paulson and my good friend Chris Cox, Honorable Chris Cox, that I'm going to be here after you leave. You're going to be gone, and we're going to be responsible to the taxpayers. The taxpayers have reacted, and the market has reacted to your plan, Secretary Paulson, by driving down Fannie Mae shares 26% today, right now, and Freddie Macs are down 29% as of this moment, just in case you're interested on how the market's reacting to your wonderful plan on bailing out Freddie and Fannie. Oh, but you may not do it because it's only as a backstop. Well, do you know in the same bill that you'd like to attach this to, there is a tax on Fannie and Freddie from $500 million to $800 million per year for a housing trust fund? Do you know that? You don't. Well, it's in the bill.
Senator, would you like me to respond to both your points? And first of all,
Go ahead, respond.
Okay. Well, first of all, I would say, I assume you would like to see a strong regulator for the GSEs.
Yes, I sure would.
What?
And we passed that 2 years ago, and it got dumped between the committee and the floor.
And I had assumed you would want to get this bill, this GSE reform bill, done.
The other part is the part I don't like,
Yeah.
the $300 billion other dollars.
Well, I got to tell you, in terms of the housing trust fund, that certainly wasn't my idea. It's certainly not something I'm pushing for.
But it's in the bill.
It is. It's in your bill. But I would say to you that I would like to get a bill done. That's not, the housing trust fund is not the priority. And in terms of the stability for the stock price, it's not something I don't think any of us can do, is stabilize the stock price. We're focused on the underlying credit, and
Are you trying to stabilize Freddie and Fannie?
we are. And
Well, your plan is not being accepted.
well, I would say this, with all due respect, Senator, the credit spreads are very strong and holding in there. I think there's confidence in the market. It's going to take time for shareholders to figure out what the value of those equities are, and I don't think government can.
Well, that's exactly what your proposal is, that government be the backstop.
Our proposal, again, Senator, is that, well, you've heard me answer it, and if you've got a better idea, I'd like to hear it. I think our idea is that by having the government provide a unspecified backstop, the odds are very low that it will be used and the cost to the taxpayers will be minimized.
Well, you know, there are a lot of us who would like to believe what you're saying, but we're a little skeptical, because every time we propose and do something, it always gets used. And you want an unlimited amount used. And none of us at this table like that idea, or some of us at this table don't like that idea of an unlimited sum of federal dollars being backstopping two GSEs, which are already assumed to be backstopped by the federal government to start with. Their price stock and their equity. And do you think that we can believe exactly what you're saying, Secretary Paulson?
I can tell you what you can believe. You can believe I believe everything I say, and that I've been around markets for a long time, and that
So have I.
I share your frustration that I'm not getting GSE reform legislation done. I share your frustration with certain parts of it. Again, all I can say to you is what I've said earlier, that
where will the money come from, if in fact, where will the money come from if in fact we have to use the backstop?
as I said to you, that it is my very strong belief that the way we can minimize the cost to the taxpayer, the way to minimize that cost
Is not
and
to
the
do it.
likelihood is to be unspecified and enhance the confidence in the market. So that's my answer. It continues to be my answer.
But it doesn't answer the question.
Well,
Where is the money going to come from if you have to put it up?
well, obviously it'll come from the government, but I would say
And
this.
who is the government?
The taxpayer. And what I'm looking to do is the same thing you are, Senator, to minimize the cost to that taxpayer. And I think the surest way to do that is.
Secretary Paulson, I know you're very sincere in your proposal.
Yeah,
But come January, you will be gone.
right.
And the rest of us will be sitting at these tables, or at least most of us,
Yeah.
and we have to be responsible to the taxpayer for what we have done.
And I don't think this is a responsible.
Then, Senator, you will vote against it, and all your wisdom.
I do everything I can to stop it.
And maybe you'll have a better plan. But
Yeah, I had one about 2 years ago.
But I'm about getting something done that can get done, that will make a difference, and in my judgment is in the best interest of the taxpayer and will minimize the cost to the taxpayer.
Mr. Chairman.
You and I respectfully disagree.
Thank you. Senator Tester.
Thank you, Mr. Chairman. Secretary Paulson, for a number of decades you were a banker. You probably wish you were back in that realm once more. But I just want to lay out a scenario for you and put on your old banker hat for a minute. If I were to come into you and ask you for an 18-month line of credit, unlimited, to be able to use any time I chose to use it within that 18 months, with little or no assets backing it up, what would you say?
Senator, what I'm asking for is unspecified 18 months. I've said I will consult with you, and if I was sitting where you are, and you were asking me for what I'm asking for, I would say yes, because given my experience in the markets, I understand what market confidence is all about. As I said, you all have had more experience than I have in government. You've had more experience watching these GSEs, playing your congressional role as it relates to them. I can just tell you, given where we are now, that if I were sitting where you were, I would say yes.
I appreciate the fact you brought forth a solution. I will go back to what the chairman said. There's been a total, from my perspective, lack of oversight in the industry, and it's gotten away. But let's just lay out the scenario. Let's say you have to use that. Let's say we don't do anything, in which case we hit a point where reserves versus loans and the GSEs hit a critical point, and then the federal government steps in anyway. Isn't that correct? Isn't that the way the current law is? I believe it is.
I would say that the current law, we have a backstop credit facility, which is $2.25 billion.
Right.
Like so many other things that I found in government, the architecture was sent a long time ago. The market changed, the architecture didn't change. That was put in place in 1971 when Freddie Mac had $1 billion of capital.
So it's $2 billion period, and that's once that money's gone, things tend to fold up pretty quickly. Correct? What impact is that going to have on our credit rating? On the Treasury's credit rating? What happens if we do nothing? That and the reserves to loans becomes in improper proportion. What happens to our Treasury credit rating when that happens?
As I said, we have no intent to nationalize.
No, I'm talking if we do nothing, right, and you spend the $2 billion. What I'm asking is what happens? What's the downside? Well,
the downside, the least of the downside, if you spend that and nothing happens, the least of the downside is the $2.25 billion. We're talking about, Senator, two huge organizations.
But it's got to be bigger than that. You're talking about potentially spending $1 trillion here. I mean, whoever you or whoever the next Secretary of Treasury is, if we pass this, you are giving temporary authority to spend any amount of money that you want, or whoever sits in your chair wants. It could be $1 trillion. And the question is if we don't, if we're not, I'm trying to give you a chance to explain what happens if we do nothing. If we do nothing, if this body does nothing, what's on the law right now, you said, is there will be a $2 billion expenditure, and then what happens? What happens to our credit union and the Treasury? I mean, our credit rating and the Treasury? What happens to the housing market, people's availability to get money, interest rates? What happens?
Yeah, rather than speculating about a lot of things, what I will say to you is this. First of all, these entities are essential right now to housing markets. I tried to explain that earlier. They're essential to homeowners. They've got securities all over the world. The confidence in their securities are essential to confidence in our capital markets.
Okay. I'm going to put that question in writing for you, because truthfully, if I'm going to vote to allow you or whoever sits in your chair the ability to spend an unlimited amount of money, I want to know what happens if I don't allow you that ability. I want to know. I don't want to know what projected interest rates are going to be and how long you're in the business, how long you project them to be high or low, or no money available in the credit market, or the list goes on and on and on, or what happens to our credit rating and the Treasury notes, all those things. I mean, I think they're really important. I mean, you might not want to speculate, but the truth is that you guys are the professionals. You guys deal with this issue every day. And if you hadn't been confirmed and weren't in this position, I mean, it's a position of leadership, and we need to know what you think. That's all. I'm not being critical. I do want to go back to what Senator Hagel said, though, about accountability, and accountability of the people who run the GSEs. Because right now, what we've seen from my perspective is a housing downturn, the banks start doing all sorts of funky stuff, going belly up and that kind of thing. And then you've got the GSEs who are supposed to be a backstop to them, if I see the picture correctly, and they're in as bad a shape as, or worse, than some of the banks that they're supposed to be the backstop for. How did this happen?
And first of all, I do not buy into the proposition that these institutions aren't viable, that these institutions are playing a very major role right now in the economy. Now, in terms of what's happened, I tried to address that earlier in a couple of other questions, and in many ways you'd be better off asking the CEOs directly. But from my perspective, you have large entities, a single line of business, home finance. You have an event where a major downturn in home prices. So it shouldn't be surprising to anybody that they'd have some issues to work through. And they've been working through those issues. They've been playing a very important role in our housing market.
Okay, my time is done. I'm sorry, Mr. Chairman, for using more time than I should have. I will have some more questions for the record. I appreciate all three of you being here today. I'm sorry I couldn't ask questions to you, Chairman Cox. I do have some questions about how the investigation is going. We need to visit again. You talked about a previous person who was on a different issue who was nailed. I would like to know how this is proceeding, because the longer it goes, the more people tend to forget. But that's all. Thank you very much, Mr. Chairman.
Thank you, Senator, very much. Senator Dole.
Thank you, Mr. Chairman. Chairman Bernanke, like Senator Hagel, I've been concerned about the health of these entities long before we got here today. In fact, sponsoring with Senator Hagel legislation to reform the GSEs since my first year in the Senate. Now, let me try to look down a little different path to shift to another future focus. Last week, in a speech that you delivered at an FDIC forum, you stated that since 2005, the Federal Reserve Bank of New York has been providing leadership for a major joint initiative by the public and private sectors to improve arrangements for clearing and settling credit default swaps and other over-the-counter trade derivative contracts. Furthermore, I believe that the offices at the Department of Treasury and at the SEC have been looking at ways to improve the clearing of CDSs. Could each of you tell us more about how regulators are attempting to make the CDS and other OTC derivatives markets more transparent?
Well, let me start. So this is a very important part. It's an unglamorous part, but it's an important part of the financial system to make sure that contracts are honored and that there's good record keeping and so on. The Federal Reserve Bank of New York has convened a group of public and private regulators and private industry participants to try to improve the speed and accuracy with which these contracts are recorded, and they've made substantial progress in that respect. They've also extended this to some other instruments like equity derivatives as well. It's very important in times like these when the situation can change quickly that everyone understand exactly what their positions are, who their counterparties are, and so on. And that's what this effort is all about. The New York Fed is also working with the private market to work towards a central counterparty who could take both sides of these trades and create the certainty that both sides would that the contract would be honored, so it wouldn't have to be bilateral and over the counter. Other changes are being made, for example, providing for cash settlement in case the bond in question is not available, and as you indicated, improving transparency to provide more information to the public and to the market about the transactions that are taking place and so on. So, and the objective is to move our infrastructure in a direction where there's more standardization, more central counterparty activity, cleaner resolution in case of a problem, and better transparency. We think by taking those steps that the fragility of the system will be reduced and will make it much better to deal with stressful situations like the ones we've experienced recently.
Could I, Mr. Secretary?
The chairman did such a great job. I'm only going to underscore what he said and say, to really emphasize it, I think of all the recommendations that came out of the President's Working Group on Financial Markets after this turmoil, this was the most important one. That it's strengthening that infrastructure. We have too much complexity, not enough standardization, and getting the protocols right, getting these contracts so they know that they will perform under stress is just critical to having our financial system work the way we need it to work.
Mr. Chairman.
Oh, I'm sorry. Mr. Secretary, you still...
Just going to say one other thing that I hadn't said, Mr. Chairman, at the start, which is I do believe, and just to underscore what you said, given what's going on in the world, people all around the world are watching us, and I think this is something that should be done quickly in terms of the GSEs, and I think this is something it will be a great confidence builder throughout the world to see Republicans and Democrats, both houses, come together and do something quickly here.
Earlier this month, the Financial Times published an editorial suggesting the need for regulators to begin to explore implications of the rise of equities trading. This is in an off-exchange trading environment, what's called dark pools. As we've seen across the derivatives market during this current credit crisis, the collapse of confidence in pricing these structured products has led to serious issues that the financial markets are still grappling with as we sit here today. I'm concerned that down the road, the equities market could inadvertently suffer a similar lack of price transparency by way of these dark pools. Could I ask each of you to comment on whether you've been tracking these entities and what your reaction is to transparency concerns in this area?
Senator, the dark pools, of course, can only function to the extent that they have a reference price in an open and transparent market. So at least so long as they're operating at the margin, there can be efficiencies with internal matching of trades. But I think your point is a very, very important one. As our markets continue to become more global and we are exposed to more and more different participants in the markets that are lacking in transparency, we have to worry as regulators that the basic function of our markets, price discovery, won't occur in the most efficient fashion unless all of the information that's necessary for that to occur is transparent. And so we have a very, very weather eye to these developments.
And you've been determined and dogged and creative and resolute about it. And I'd ask you to take a look at that letter and see if there's anything Treasury could do to, if you can endorse it and highlight it. Basically what we're asking is to take a share of the counseling money and use it for a program like that. I don't know if you have any reaction to that.
Well, Senator, it sounds like a good idea, and we will be on it. And you've been particularly constructive in working with us and helpful, and appreciate the ideas. And this is one we'll very much look at carefully and follow up on. Mr. Chairman, could I just say one other thing, and when we're talking about the...
I'm not sure Senator Casey's through. Are you through, Ben?
Just have about two more...
Oh, sorry. I'm sorry, Senator.
2 more minutes. I wanted to ask you about, you had a couple of questions that were posed to you today regarding the GSE reform, and in particular, in your testimony, the second part of your proposal talks about 18-month temporary authority to purchase only if necessary equity in either of the 2 GSEs. Am I correct in understanding that authority, the dollar amount would be unlimited?
Yes, Senator, on that, again, we weren't sure how to size that, what would be necessary. Again, the reason we didn't want to put a specific number on it, we thought if we were unspecific, it would be more confidence inspiring, and it would put the government in a stronger position and minimize again the cost of the taxpayer.
So the reason for the unlimited nature of it is to send a signal to inspire confidence.
It was to send a signal, inspire confidence, no specific plans. But again, to get back to the other topic we talked about with the backup facility. As I said before, in 1971, Freddie Mac, Treasury was given a $2.25 billion line of credit for a backup facility, and then Freddie had $1 billion of assets. Today, they're, at the end of 2007, they had $794 billion. We're asking for this for the whole system. There was a $4 billion line of credit for the Federal Home Loan bank system, and today it is. In 1980, they had $54 billion of assets. Today, they got $1.3 trillion. With Fannie Mae, in 1971, again, $2.25 billion Treasury facility. Today, they've got $883 billion. Then it was $19 billion. So again, I just think this is another example of what I found throughout government: a regulatory structure, a system, architecture that was set up to deal with a world that had existed at one time, not being updated to deal with the world we have today.
One more point. I'm just about out of time. This is not in the form of a question, but I was struck by something you had in your testimony. I'm looking at the second page under the second part of your proposal. This just jumped off the page at me, where you conclude that section, and I don't say this to be argumentative. I say it to ask you to deliver a message to the person that you report to. You conclude by saying, you conclude this section by saying, hopefully, when you're talking about GSE reform bill, hopefully about to be enacted with the modifications we're recommending today. The word enacted jumped off the page, because look, if we're going to meet the goal that you've set forth of enactment, and we all want something enacted, the President of the United States, President Bush, has to show some leadership on this. And what we've gotten so far on this particular legislation are veto threats, and in particular, he's talking about vetoing this legislation probably for several reasons, but the one reason that he keeps identifying is CDBG money, Community Development Block Grant money, not the modifications that you're recommending. So I'd ask you to tell the President that if this is to be enacted as you want and I want and a lot of other people, he's got to help us here. He can't just be a partisan fighter on this. He's got to help us get this passed?
Senator, let me say the President is very committed to getting this passed. Focus has been on GSE reform, modernization. We in the administration have taken the view, which is a strong view, that the CDBG block grant is not called for, and it has been my expectation all the way along that when the bill got to the President's desk, it wouldn't have that as part of it. And I think that continues to be my expectation. And again, I just hope we can get this we can get this done quickly, that we don't take hostages, and that it's just to be a great signal for the whole world to move this through quickly.
Thanks very much.
Thank you.
Senator Schumer.
Well, thank you, and I apologize to the witnesses. As I'm sure people have mentioned, we have our Democratic and Republican caucus lunches, and so I had to be there. First, not my main point of questions, but I wanted to underscore what Senator Casey said. We are going to need broad bipartisan support to get this done. There's already word that one Republican senator said he would do everything he could to block it, which then means we need 60 votes, so we have to do this in a bipartisan way. And we just need your commitment and the President's that they're going to do everything they can to get this done and done quickly. I, for one, think that you have put together a good plan. And you're sort of in a funny situation here. I mean, markets always get overconfident. That's the history of them. That's why we have booms and busts. But in this world of universal knowledge, everyone gets overconfident at once. And it's not one corner of a state or then one corner of a country or even one country in the world, but everybody. And so when the problem occurs and everyone thinks, okay, we can all do no-doc mortgages because housing values will always get up, everybody gets in trouble. And that means you need broad solutions. And so I, for one, think that the irony here is the more limits we put on this, the more worried the markets be. And if the real issue here is not the fundamental strength of Fannie and Freddie, low as their stock price is, but rather the psychology, in a certain sense, the more open-ended the power, the ability, not the use, but the ability, as I think you said, it's a bazooka in your pocket that you hope you don't have to use, the better. So I hope we can move this quickly, and I think we ought to be careful before imposing various limitations in terms of giving the markets confidence that if, God forbid, something bad happens, and I don't think it will, the government will be there. So I salute you on that. The two kinds of limitations that I think are appropriate are one in time. You've had 18 months. Maybe it should just be a year, and we'll renew it if, God forbid, it's still bad. The second, and you've done some of this, is to make sure the government comes first over the shareholders, that the government is fully repaid before the stockholders and other financial interests get repaid. Can you assure us that the plan we put together will keep that limitation, which I think is a reasonable limitation that won't spook the markets in any way, is there?
Yes, Senator. As we had a discussion, and Senator Shelby raised some issues there and said that as we went through it, it's very difficult to figure out how to structure something when we haven't even made a decision, and there's no decision, no intent at this time to put money in. I would say if we do, we will be very mindful of structuring something in a way in which it protects the taxpayer.
And, you know, Freddie's debt offering yesterday, as I understand it, was oversubscribed and they were able to borrow at low rates.
Yes.
I don't think that would have happened without this plan being there in the back of people's minds. And that, I think, attests to the need for it, the need to do it quickly, and the need not to spend too much time just arguing about limitations and delaying it for a couple of weeks. Because even if there's a 5% chance that you're at the precipice, you don't want to even risk falling over. You agree with that?
Thank you for your support.
Yeah, okay.
Thank you.
Second question I have to Chris Cox. This is on short selling. I asked Chairman Bernanke at the first half. I'm hearing from more and more responsible people that some kinds of limitations should be placed on short selling, not to eliminate it. It's a fundamental part of the market. We need it, and it does a lot of good things. A lot of short sellers prove companies are overstating or being too optimistic. In the old days, we had the uptick rule, which seemed to work pretty well. And then we went from selling stocks in eighths, and an eighth of a point uptick was significant, to selling it in hundredths, and a 1/100th of a point is not very significant. But what would be wrong with re-implementing the uptick rule, not for one uptick, but for, say, 12 upticks, so you're back to where you were before? Particularly, and I think I talked about this with Chairman Bernanke, for financial stocks, which seem to be under particular assault and also are more subject to the psychology we talked about than those who make tangible goods.
Well, Senator, I think you're right in several respects. First, our Rule 10A1, which goes back to 1938, had much more of a real-life meaning when stocks were trading in eighths than after decimalization. The effectual or lack of effectual nature of this rule was studied more carefully by economists within and without the SEC than I think anything that the Commission has done in recent years. And it was just very clear that that rule no longer mattered, that everybody was trading around it, it didn't have any point. What we do know, however, and this is the second point on which I agree with you, but what we do know is that the combination of short selling and other manipulation in the market can be a very, very volatile mix. Indeed, it's a witch's brew of very dangerous activity. So we want to make sure that the combination of short selling and the intentional spread of false information can occur in our markets. We're doing a lot of enforcement around that. The emergency action that we announced today is going to have a lot more effect than the price test, which economists have told us didn't do anything.
Yeah, no one believes you'll be able to track down purveyors of false information very often. So it's not very, it's true we should do it, but it's not very effective. And some more...
Yes, no, the emergency action I'm talking about is not, although the enforcement
I know
piece
that.
I think we'll get better at, but what I'm talking about is a hard locate requirement, a pre-borrow requirement for...
Just tell me for a minute, why would that be more effective than a modified uptick rule, which seemed to work pretty well for the decades before we went to decimalization?
One of these is aimed at preventing naked short selling.
Yeah.
If you're really trying to drive a stock down and you want to do it in a manipulative fashion, combining false information or rumors or what have you with the ability to put so much pressure on this stock that you're using shares that might not even exist is the sort of thing that I think investors have a right to have the federal government guard against. But another thing that the Commission is going to be looking at, in addition to broader rulemaking on the short selling or naked short selling side, is the question of whether some other kind of a price test, it's not in pennies, that's not related to a tick, might be useful for circumstances such as we find ourselves in now. And we are very open to that, and in fact, we're going to be doing it.
Just Secretary Paulson, do you have any comments on that, given your broad experience in the markets?
I would have the following comment. You're very right that the regulatory architecture didn't keep up with the change in markets. When you went to decimalization, the uptick rule became meaningless. You know, stocks at 100, someone could bid it up to 100.01 and then short it. I would say number one. Number two, I can tell you that Chairman Cox has been focused on many things that are making a big difference, and he's been focused very hard on this area, and I'm very supportive of the steps he's taken.
Thank you very much. Senator Shelby.
Thank you, Senator Dodd, Mr. Chairman. I just want to recapitulate here, just for the record and for our knowledge base, that you're proposing, Secretary Paulson. And these are your words. First is a liquidity backstop. That's number one. The plan includes an 18-month temporary increase in Treasury's existing authority to make credit available for the GSEs. And you also don't want to put a dollar amount on it. Now I understand sometimes the reason for ambiguity, not stating things. But I think you could be risking the taxpayer's dollar here. I think we better look at this. We'll consult with you on this, but to give you, and we have a respect for you as Treasury, a blank check, I'm not sure, but I understand why you don't want to put a dollar amount on it. I think I did. Secondly, your other set of your proposal is to ensure that the GSEs have access to sufficient capital to continue to fulfill their mission. I think that's very important. And this gives Treasury an 18-month temporary authority to purchase, if necessary, equity, in other words, stock, in the two GSEs. And there's no dollar amount on that either, you know, and so forth. Third is something we've been working at a long time, dealing with the GSE reform, and that is to bring about a strong regulatory reform and so forth, and a strong regulator of GSEs. Now, are you basically proposing a standalone, as Senator Dodd and I have, regulator over the GSE with a lot more power than they've had in the past, which we've had, and then a role for Treasury and the Federal Reserve here, but you're not making yourself and recommending to yourself, I hope, and and for the Fed, you'd be kind of co-regulators. Am I correct?
I was not even. I don't believe that. I don't see a role for Treasury in the consultative regulatory process.
Okay.
That would not be my proposal, but for the Fed, it would be. And so, again, as you've stated, it wouldn't be co-regulator, not at all. It would be, we'd have a strong, independent regulator, and then the Fed would have a consultative role, as we are suggesting more broadly across the whole economy, but for the reasons that I've stated before. But again, I'm not suggesting that role for Treasury.
Well, I think the Fed will obviously play, since they're the central bank here, that will play a role in any kind of a rescue package or whatever you want to call it. On the other hand, we haven't reached the point of legislation to fulfill some of your recommendations on what role the Fed will play in the future in our financial regulation, what role the SEC will play, or what role Treasury will play, and so forth. So I think these three things, Senator Dodd, I would recommend Senator Dodd, is just a member of the committee, that we try to work with you on this.
Right.
We also try to protect the taxpayer and see where we're going, Mr. Chairman.
Yeah. And I would just very respectfully say, I think if you institutionalized a consultative role for the Fed on something this important, it would inspire market confidence and it would help protect the taxpayer. Thank you.
Let me wrap up here. And first of all, let me thank the three of you very, very much, particularly Chairman Bernanke, who's been tremendously patient here for a long time before this committee this morning. But I don't think anyone would argue. I can't think of another moment in time, certainly in my tenure, when we, as much as at stake, as decisions we have to make in the coming days. And let me end where I sort of began, Secretary Paulson, by commending you and others who worked over the last number of days in proposing some ideas here. Inaction is not an option, and clearly we need to consider some steps that need to be taken. Having said that, I also want to emphasize to you, and I understand the need for moving expeditiously, but I want to make very sure, to the extent possible, we've thought about this, to the extent we have to here going through this. There are a couple of issues that come to mind, and Senator Shelby and I are going to sit down, and I'll be talking with my members of the committee to go through these steps and think it through carefully. For instance, just as a suggestion, I say to you here, and again, and I realize the statement is not a legislative proposal, so I understand the distinction between the remarks you've made here and what has to be drafted if, in fact, we're going to include some things. But on this issue involving the equity interest here, at least the language of your proposal talks about a consulting with the GSEs, but I think you're going to have to spell out specifically if the GSEs are going to be directly involved, that needs to be covered. It can't be the sole discretion of Treasury, in my view, or you're going to have the private markets react negatively. I happen to agree with Senator Schumer that probably the federal government ought to be protected. I suspect that that's going to have an undesirable reaction by the private market if they feel as though they're going to come in second at a time we're trying to get private capital into this. So we've got to think this through. And this is not a contradiction to get what needs to be done, but I want to sit down and talk with people to make sure that before we draft stuff here, we're not going to do something that we're going to regret. Now, you don't intend that, and I know that. I want to ask, because Chris, we haven't asked you about this, and you've got, your job is to protect investors. What are your reactions to this? I mean, you're a talented individual. You served with us up here in the Congress. You know these issues pretty well. What is your reaction to this? This is important to get some views that you would have on this.
Well, as you know, the SEC's had its own involvement with Fannie and Freddie with enforcement actions. In fact, very recently, in the last year, bringing actions that have nearly broken records for penalty size and so on because of accounting irregularities and fraud. We want to make sure that as Freddie now becomes a reporting company, so both Fannie and Freddie will be reporting companies, as you consider whether or not to maintain an exemption under the 33 Act for their debt and their mortgage-backed securities, or whether they should be treated like other private companies, that they do in fact start to look like other private companies. My recommendation to this committee before and again today is that that exemption be discontinued and that they become reporting companies essentially like any other private entity. I would hope that in addition to what we're doing right now, which is in extremis, that we keep in mind the end state that we're trying to achieve, and that we quickly learn the lessons of the moment, which include the fact that the systemic risk that has been able to be located in here, in part because of the government embrace or the perception of government embrace of them, that no longer be the case in the future. I think the combination of socialized risk and private profit is a very suspect model. And so I hope that the Congress takes as much advantage of this opportunity as you possibly can to treat those problems as well as the immediate problems. And I think given the fact that Fannie and Freddie together comprise about $5.3 trillion out of the $12 trillion U.S. mortgage market, suggests that we haven't any choice but to deal with them in the near term as we are doing, because of that implicit government guarantee that's always been there.
So this idea that you've heard the Secretary talk about is one that you think makes some sense?
Well, obviously there's a big distance between this proposal of making clear to the market that the government is going to stand behind Fannie and Freddie and how you in Congress choose to execute it. And I think it's important simply for the SEC as the investors advocate, as the administrator of our rules and regulations for disclosure and so on, to observe that, to the extent that you can make Fannie and Freddie fit in with the rest of that system, as they have been moving towards in any case, and accomplish that in the bargain, so much the better.
But we may want to call upon you or your staff to, in the next matter of hours and so forth, as we look at all of this, to get some thoughts on this. I tried to think, if I could, of another example in my 27 years where we had one regulator have to consult, at least in the language you've used here, Hank, here, and the way we described the Fed's role here. I couldn't think of another example where we had one regulator statutorily, as Jack Reed was asking the question, we sort of expect that, as the chairman pointed out. He consults all the time with the SEC, I presume with the Treasury on matters that goes on every day. But statutorily requiring it takes this to another level. And I'm just uneasy about what we're trying to achieve here. I want to hold some hearings at some point here on the architecture for financial services and the regulatory needs of the 21st century. Yep. And that needs to be done. I'm not sure I want to get to a financial services administration model yet that Great Britain has. And I respect that model. I think it works well for them. But I want to, as a chairman of this committee, listen to a lot of different ideas as to how we ought to create that architecture. I wonder if we're backdooring this a little bit here and trying to get to that point in a moment like this, or whether or not we ought to be.
Well, that's obviously your decision, and this is a major decision. And again, in terms of the UK, we suggested it. I believe they're moving to adopt it. Okay, I don't say they have this now. And I think the thing you need to ask yourself, and you need to ask yourself long and hard, is when we have a system that was developed when commercial banks were not only the dominant, the predominant financial institution. And now we have a system where we've got the GSEs, we've got hedge funds, we've got investment banks, and it's going to be a long time, no matter how many hearings you hold, before the regulatory structure of this country is changed in a way in which it meets up with the world in which we live in. And so, as we've noted, that if people look increasingly to the Fed to play a cleanup role, to me, we need to put ourselves in a responsibility where we minimize the likelihood that we get into situations like this. And one way to do that is to have one regulator across the whole economy, not to supplant the other regulators, but to be able to look at risks to the system, and when they see risks to the system, be able to get the information, see the risks, and play a role. But as you rightfully point out, which is very fair, we have presented this idea, okay, and presented the idea, and what we're doing is bootstrapping it onto something which we felt would be the right move and would inspire market confidence and is an obvious step. But you may choose not to do that now, but that's...
Listen, I'm more in agreement with your overall needs, in fact, in how we ought to look at the architecture down there. That's a very legitimate question. I know there are a lot of different ideas as to what that ought to look like. Let me ask you, Mr. Chairman, I know your answer is, look, whatever Congress decides to do, you accept those conclusions. But I need to ask you whether or not you would want this role that's been described over the GSEs. In your view of the role of the Federal Reserve Bank, is this, put aside whether or not we decide to give it to you or not, I want to know whether or not you think you ought to have it.
Well, it bears to some extent on this overall architecture. Yeah. I think we need to think about the whole system and whether or not you want to have this kind of center field safety, whatever position, and if so, what the appropriate authorities would be to go along with that responsibility. So this, as the Secretary points out, this is just a sort of a portion of this overall structure that the blueprint recommends. If we do only that piece, then it isn't really doing the whole approach. And so in that context, it would really be ratifying to some extent what we already do, which is talk to other regulators, and we talk to OFAO. I do think that we could be helpful to them. They can provide information to us. You know, we are willing, if it's deemed valuable, to do it. But I think doing that is not the same thing as accepting this overall model that the Secretary Paulson's blueprint puts forward. And that would require, as I've said, I think that's a very interesting direction worth discussing, but being risk averse, I would want to make sure that if the Federal Reserve were given such an overarching authority or overarching responsibility, that the authorities that it received would be commensurate and allow it to fulfill that responsibility.
I understand that. In other words, if I'm understanding you correctly, obviously the consultative role, as I understand it, we all understand the word consultative role, but I think I hear you saying you don't want veto power over OFAO.
No, I don't think so. But I'm, again, we could discuss it in the context of a broad reform. In this context, again, we'll do whatever Congress wants, but I think the most valuable thing would be for us to be in a consulting, discussion, information exchange type of relationship.
But not a veto role.
No.
Not the super regulator.
That's not my thought at this moment, but we didn't want to think about the whole system.
Mr. Chairman, let me just add one thing to what Ben said, which is something we've talked about extensively, obviously. As part of the overall regulatory architecture, if you decide to do that, in the months ahead. To make this work for the Fed, they would have to have, with the overarching responsibility, they would have to have certain authorities. They would have to have, they wouldn't become the regulator for any of these entities, but they'd have the power to get information, to disseminate information, to consult on the capital rules, and then if they find a real deficiency, they would need to have the powers to deal with that, corrective powers. So what the chairman is saying is the idea that's been proposed, which would be part of something that would be much broader that you would do if you decide to do it, which would be, because we have no one today that looks across the entire financial architecture, and to be able to have responsibility for saying OTC derivatives, as you know, the senator pointed out, are a problem, or to be able to look at one thing or another. So what we've done here was just proposed a portion of that.
No, here, Mike, look, you're asking us to act expeditiously on something that clearly needs some urgent attention. This is an issue that deserves a lot of thought and consideration. There's a broader question, and I just don't want to have us graft onto a problem we need to address in the next few days with something that's far more far-reaching, that deserves a lot more thought and consultation before we move in that direction. And I'm, as I say, relatively sympathetic to the direction you want to move in. I don't think we want to do exactly the models we look in some other places, but clearly some additional thought on the overall architecture. That's my concern. Yes, Chuck.
Yeah, thanks. I think this is a great discussion. I appreciate you leading it. You know, but the big conundrum we have in our financial system is it has evolved, as Chairman has said, away from just commercial banks. Systemic risk is far more interrelated to the relationships between these hundreds and thousands of entities, and the responsibility for systemic risk is chopped up in different pieces. I mean, Bear Stearns is a classic. The authority involved for systemic risk was the Fed, but the authority that looked at Bear Stearns was the SEC, and it sort of didn't add up. And so I, for one, have been pretty strongly of the view a single regulator, particularly in regards to systemic risk, but in general makes sense, or at least more unified regulation. And at least to my way of thinking, and I couldn't agree with you more, Mr. Chairman, to take this aspect, which is looking at the GSEs and then bootstrap it and say we should do it for everybody, would be a mistake. On the other hand, when the GSEs present such systemic risk problems, you need somebody to do this. And, you know, I don't think OFEO, for instance, has the ability to look at the systemic problems that the GSEs would cause given their... So I don't, you know, I think if we took your admonition in mind, be careful that this doesn't bootstrap it to everybody, but didn't shy away from doing it, because I think we do have to do it with the problems the GSEs had. I think that may be a way to cut this knot, as opposed to just not doing it at all.
Yeah, because the point we've made in the strong regulator is because today we haven't rationalized this. We have HUD involved, we've had obviously OFEO involved, we've had others, so it's been to try and get some consolidation with that strong regulator that's in the bill that passed the Senate last week was specifically designed to do this. What I'm leery of a little bit is, having done that with this legislation, we now begin to bifurcate it once again at a critical moment when we need exactly what you said over and over again today, that very strong regulator here. So that's the mere other point I wanted to make. But this has been worthwhile.
Chairman?
Yeah. We'll end on this note.
I don't know who will be the answer. Would the Fed be the answer here? But it's obvious just from our discussion here that more taxpayer exposure, I think, brings about, necessitates more taxpayer protection. We're potentially layering taxpayer resources on top of massive systemic risk, and how do we balance that? How do we go? I think that the chairman will, I'm sure, hold a lot of hearings on this.
We'll do that as well. This has been very worthwhile, and again, my compliments to all of you for your involvement and in your sharing some thoughts. We're going to be in very close touch with you now the next couple of days here. We've got to make some decisions. Be very, very important. So the committee, and I said it to my committee members as well and your staffs here, we need a lot of work on this over the next few days. Thank you all very much.